While the world watches gold, China has been quietly moving pieces on a different chessboard entirely. Not for jewelry, not for speculation, but for something far more calculated. They've positioned themselves at every critical junction: mining, refining, supply chains. And now there's a number, $25,000, a threshold that could detonate the entire derivatives market, forcing a price discovery event unlike anything seen in modern commodity history. The path to $100 per ounce isn't a prediction. It's a mechanism already in motion, and most investors have no idea what's coming. Welcome to John Ag. If you've been around long enough to remember when a handshake meant something, when people kept their word, and when sound money actually meant something real, then you know the value of straight talk. No hype, no nonsense, just analysis that matters. If that resonates with you, I'd be grateful if you'd subscribe to this channel. Think of it as joining a conversation, not a crowd. And I'm curious, where are you watching this from today? Drop your location in the comments. I'd like to know who's paying attention to what's unfolding. Now, let's get into what's really happening with silver. In the spring of 2015, something unusual began happening in the global silver market. While Western financial institutions were busy managing equity portfolios and bond yields, while American investors were chasing tech stocks and real estate, China was making moves that most analysts completely missed. They were buying silver, not in small amounts, not as a hedge, but systematically, strategically, and at a scale that would only become clear years later. The pattern started in South America. Chinese state-owned enterprises began acquiring silver mining operations in Peru, Bolivia, and Mexico. These weren't headline-grabbing deals, no major press conferences, no dramatic announcements, just quiet acquisitions of mines that produced millions of ounces annually. By 2018, China controlled nearly 40% of global silver refining capacity. They had built the infrastructure, trained the workforce, and positioned themselves at the critical junction between raw ore and finished product. Every ounce of silver that moved through global supply chains now had a high probability of passing through Chinese facilities at some point. But the mining assets and refining capacity were only part of the picture. China's official silver reserves, the numbers reported to international agencies, showed modest holdings, nothing particularly concerning. Standard diversification for a major economy. Industry analysts, however, began noticing discrepancies: import data from Hong Kong, shipping records from major ports, customs documentation that didn't quite align with official reserve figures. When researchers started piecing together the puzzle, a different picture emerged. Conservative estimates suggested China had accumulated somewhere between 30,000 to 50,000 metric tons of silver over the past decade. That represented a significant percentage of total above-ground refined silver available globally. And they weren't slowing down. In 2022, Chinese imports of physical silver reached record levels. While Western investors were selling, while ETF holdings were declining, while sentiment in precious metals markets was turning negative, China was absorbing physical metal at prices that seemed almost too good to pass up. The question industry insiders began asking was simple but profound. Why? Silver isn't just a monetary metal. It's an industrial commodity with applications across dozens of critical sectors. Solar panels require significant amounts of silver for photovoltaic cells. Electric vehicles use substantially more silver than traditional combustion engines. 5G infrastructure, medical devices, water purification systems all depend on silver's unique properties. China is the world's largest manufacturer of solar panels. China dominates electric vehicle production. China is building technological infrastructure at a pace no other nation can match. And China now controls the supply chain for the metal that makes all of that possible. This wasn't speculation. This wasn't investment diversification. This was strategic positioning for industrial dominance in the sectors that will define the next 30 years of global economic development. But there's another dimension to China's silver accumulation that many observers overlook. Throughout history, nations that anticipate major shifts in the global monetary system have consistently moved into hard assets before those shifts occur. Gold and silver, the oldest forms of money, tend to attract attention from governments that see currency instability on the horizon. China has been steadily reducing its exposure to U.S. Treasury holdings. China has been encouraging bilateral trade settlements in yuan rather than dollars. China has been building alternative financial infrastructure, payment systems, and monetary arrangements that bypass Western-controlled mechanisms. And China has been accumulating silver quietly, systematically, without fanfare. The time frame matters. Most of this accumulation happened during a period when silver prices were relatively suppressed. While gold was making headlines and reaching new highs, silver remained range-bound, undervalued relative to historical ratios, and largely ignored by mainstream investors. China bought during the neglect. They positioned themselves while attention was elsewhere. And now, in 2025, the market structure has fundamentally changed. The physical metal sits in Chinese vaults, in Chinese refineries under Chinese control. Meanwhile, on the other side of the trade, major Western financial institutions hold enormous short positions in silver derivatives. Paper promises to deliver metal, backed by leverage, dependent on margin requirements, vulnerable to price movements. And there's a specific number where that vulnerability becomes critical, $25,000 in margin requirements per contract, a threshold that could change everything. Most people think markets move based on supply and demand. They're wrong. Markets move based on who needs to act and who can afford to wait. In the silver derivatives market, there's a built-in detonator that most investors don't even know exists. It's called margin. And right now, it is sitting at a very specific threshold that could trigger the largest forced liquidation event in commodity market history. Here's how the game actually works. A trader wants to control 5,000 ounces of silver without buying the physical metal. Instead of paying the full price, they enter a futures contract. The exchange requires them to post collateral, a fraction of the total value, called margin. Let's say silver is trading at $30 per ounce. The full contract value is $150,000, but the trader only needs to post around $8,000 to $10,000 in margin to control that entire position. This is leverage. And in the silver market, the leverage ratios are extraordinary. Now, here's where it gets interesting. When prices move against a leveraged position, the exchange issues a margin call. The trader must deposit additional funds to maintain the position. If they can't, the position gets liquidated automatically. No negotiations, no extensions, forced selling, or forced buying, depending on which side of the trade they're on. The current margin requirement structure in silver futures has a critical threshold around $25,000 per contract. This number isn't arbitrary. It represents the point where cascading liquidations begin to accelerate. And when silver prices rise past certain levels, margin requirements increase proportionally. Positions that were manageable at lower prices become unsustainable. And here's the dangerous part. The silver derivatives market has approximately 150 to 200 days worth of global production held in short positions by major financial institutions. Read that again. Banks and trading firms have sold, on paper, more silver than the entire world produces in half a year. They don't have the physical metal. They have contracts, promises, derivative instruments backed by the assumption that prices will remain stable or decline. But what happens when prices don't cooperate? History provides uncomfortable answers. In 1980, when the Hunt brothers attempted to corner the silver market, prices exploded from $6 to $50 per ounce in just a few months. The leverage embedded in the system created a feedback loop. Rising prices triggered margin calls. Margin calls forced buying. Forced buying pushed prices higher, which triggered more margin calls. The entire structure nearly collapsed. Exchanges changed rules mid-game, regulators intervened, and the market was essentially frozen to prevent systemic failure. That was 1980, when silver derivatives represented a fraction of today's market size. The leverage today is substantially greater. The concentration of short positions is substantially greater, and the amount of physical metal available to settle contracts is substantially smaller relative to paper claims. Now, add another variable, counterparty risk. When one institution faces a massive margin call and cannot meet it, who's on the other side of that trade? Another institution. And if that institution was counting on the first one to perform, and they can't, the failure spreads. This is how localized problems become systemic crises. The 2008 financial collapse wasn't caused by mortgages. It was caused by derivatives built on mortgages. When the underlying asset moved in an unexpected direction, the leverage multiplied the damage until entire institutions failed. Silver derivatives operate on similar mechanics. And right now, the market structure is more fragile than at any point in the past 40 years. Here's what makes the current situation uniquely dangerous. Physical silver supply is constrained. Mining production has plateaued. Recycling can't fill the gap. Industrial demand is rising due to green energy mandates and technological applications. Meanwhile, financial institutions have sold enormous quantities of paper silver, assuming they'll never have to deliver physical metal. But China, with its massive physical holdings and control over supply chains, can influence the very thing these institutions bet against: physical delivery demands. If entities holding long positions begin demanding physical settlement instead of cash, the entire derivative structure faces a problem it cannot solve mathematically. There isn't enough physical metal to satisfy the paper claims. And when that realization spreads, when margin requirements breach the $25,000 threshold and keep climbing, when forced liquidations begin and prices spike, the feedback loop activates. The mechanism that has kept silver prices suppressed for decades becomes the exact mechanism that sends them vertical. It's not a matter of if, it's a matter of what triggers it. There's a pattern that repeats throughout economic history, and most people never see it coming. It happens when three forces, seemingly unrelated, collide at the same moment. Right now, in 2025, those three forces are converging on silver. The first force is invisible to most people because it happens slowly, then suddenly, currency debasement. Since 2020, global central banks have expanded money supplies at rates that would have been considered reckless just a generation ago. The Federal Reserve's balance sheet exploded. The European Central Bank followed. The Bank of Japan never stopped. They called it quantitative easing, liquidity provision, emergency stimulus. But the mechanism is simple. They created currency units that didn't exist before. And when the supply of something increases dramatically, its value relative to scarce assets changes. Gold responded predictably. It rose. But silver? Silver did something strange. It lagged. While gold climbed toward new highs, silver remained range-bound, undervalued by historical standards, ignored by institutional investors who viewed it as too volatile, too small, too industrial. That gap created an opportunity, and someone noticed. By 2023, a quiet shift began occurring in international reserve management. Central banks that had exclusively focused on gold started exploring alternatives, not because silver is a traditional reserve asset, but because the dollar's role as the global settlement currency was showing structural cracks. The BRICS nations, Brazil, Russia, India, China, South Africa, began discussing alternatives to dollar-denominated trade. Bilateral currency agreements emerged. Swap lines expanded. The percentage of global trade settled in dollars declined for the first time in 70 years. This wasn't rebellion. It was mathematics. Countries holding trillions in dollar-denominated reserves watched as those dollars lost purchasing power year after year. The incentive to diversify became overwhelming. But diversify into what? Gold has limited industrial use. It's purely monetary, purely a store of value. Silver, however, sits at a unique intersection. It's a monetary metal with thousands of years of history as currency, and it's an irreplaceable industrial commodity essential to modern technology. That dual nature makes it something different, something that holds value from two directions simultaneously. Now add the second force, industrial demand that cannot be delayed or substituted. The global push toward renewable energy isn't optional anymore. Governments have mandated it. Corporations have committed to it. Infrastructure spending is allocated toward it. Solar panels require silver. There is no viable replacement for silver in photovoltaic applications that matches its efficiency. Electric vehicles require substantially more silver than traditional cars. The transition to EVs is accelerating, not slowing. 5G networks, medical imaging equipment, water purification systems, semiconductor manufacturing all depend on silver's unique electrical and thermal conductivity properties. This demand isn't speculative, it's structural, and it's growing at approximately 4 to 6% annually. Meanwhile, silver mine production has essentially flatlined. Ore grades are declining. The easy deposits were extracted decades ago. What remains requires more energy, more capital, more time to extract. Even at higher prices, bringing new mines online takes 7 to 10 years from discovery to production. The supply side cannot respond quickly. And here's the critical part. Most analysts miss above-ground inventories. The stockpiles of refined silver available for immediate use have been declining steadily since 2015. Industry data shows that total visible silver inventories represent less than 1 year of global industrial consumption. 1 year. In gold, above-ground stockpiles represent roughly 70 years of annual mine production. Silver has no such buffer. The third force is perhaps the most overlooked: the ratio between paper claims and physical metal. In the gold market, derivatives and paper gold certificates exist, but the ratio between paper and physical is roughly 4 to 1. For every 4 ounces of paper gold, there's approximately 1 ounce of physical backing it. In silver, that ratio is estimated between 100 to 1 and potentially as high as 250 to 1. For every physical ounce, there are hundreds of ounces worth of paper claims. This works fine, as long as nobody asks for physical delivery. But the moment physical settlement becomes preferred, the moment holders of paper contracts demand metal instead of cash, the system faces a mathematical impossibility. There simply isn't enough physical silver to satisfy the claims. And China, sitting on massive physical stockpiles, controlling refining capacity, dominating supply chains, knows this. They've positioned themselves on the scarce side of the trade. Meanwhile, Western institutions hold the abundant side. Paper promises backed by leverage and assumptions. The convergence is this. Weakening confidence in fiat currencies pushes investors toward hard assets. Structural industrial demand absorbs available supply regardless of price. And a derivatives market built on leverage faces physical delivery demands it cannot fulfill. These three forces don't just add together, they multiply. When currency debasement accelerates, when industrial demand cannot be met, when paper markets face delivery pressure, price discovery doesn't happen gradually, it happens violently, and the path to $100 per ounce stops being a forecast. It becomes a timeline. There's a difference between a price target and a destination. A price target is speculation, a guess based on charts and sentiment. A destination is where the mechanics inevitably lead. $100 per ounce for silver isn't a prediction. It's the mathematical endpoint of forces already in motion. But the path matters, because understanding how we get there determines who survives the journey and who gets crushed by it. Let's map the route. The first catalyst doesn't announce itself with headlines. It starts quietly. In the physical delivery queues of major exchanges, a mining company, a solar panel manufacturer, an industrial buyer decides they want physical metal instead of rolling their futures contract forward for another month. Standard procedure. Except this time, the warehouse receipts take longer to process. The metal isn't immediately available. Delivery gets delayed by a week, then 2 weeks. Nobody panics yet. But word spreads among traders. Physical tightness. Backwardation appears in the futures curve, meaning near-term contracts trade at a premium to longer-dated ones. This is the signal. In a normal commodity market, storage costs mean future delivery should cost more than immediate delivery. When that inverts, when people are willing to pay more for metal today than metal 6 months from now, it means something fundamental has shifted. Physical scarcity has entered the equation. At this stage, silver might be trading at $35 to $40 per ounce. Retail investors haven't noticed yet. Mainstream financial media isn't covering it. The move feels like normal volatility, but institutional desks are watching, and some of them are holding enormous short positions that suddenly look uncomfortable. The second stage begins when the first margin call goes unanswered. A mid-sized trading firm, a proprietary desk at a regional bank, someone over-leveraged and undercapitalized gets caught wrong-footed. Silver jumps $8 in a single session. Margin requirements spike. The firm doesn't have the capital to meet the call. Their positions get liquidated automatically. Forced buying in a rising market. That forced buying pushes prices higher, triggering margin calls at the next tier of institutions. The cascade has started. Now silver is at $55. This is where mainstream attention arrives. Financial news networks run segments. Silver surges on industrial demand. Analysts who ignored the metal for years suddenly have opinions. Retail investors start buying. FOMO kicks in. ETF inflows accelerate. But here's what most people don't understand. The real move hasn't even begun yet, because up until this point, the price action has been driven by derivatives, unwinding, and speculative positioning. The physical market, the actual metal, hasn't truly tightened yet. That changes in stage 3. Sovereign entities and strategic buyers step in. Countries that have been watching China's accumulation, nations that understand what's coming to the global monetary system, begin acquiring physical silver as a reserve diversification strategy, not through futures contracts. Physical metal, bars, coins, allocated storage. And when governments start competing for a finite resource, price becomes secondary to availability. At this point, silver might be trading at $70 to $75. Industrial users face a crisis. Solar manufacturers who locked in supply contracts at $30 per ounce are now paying spot prices at $75. Their margins evaporate. Some halt production. Others pay whatever it takes to secure metal. This is where shortages become visible. Delivery delays extend from weeks to months. Premiums on physical metal over paper prices widen dramatically. You can buy a futures contract for $75, but actual metal in hand costs $90. The disconnect between paper and physical becomes undeniable. And then, the final stage. A major institution fails to deliver on a large contract. It could be a bank. It could be a bullion dealer. It could be an ETF that claimed physical backing but can't produce the metal. The failure triggers legal disputes, regulatory investigations, and most critically, a crisis of confidence in paper-silver markets. Investors who thought they owned silver through ETFs and certificates suddenly realize they own promises, not metal. The rush to convert paper to physical overwhelms the system, and there isn't enough physical metal to go around. At this stage, price discovery breaks down entirely. Silver trades at $100 on exchanges, but physical premiums push real transaction prices to $120, $130. Some dealers stop selling altogether. They can't source metal at any price. This isn't speculation. It's what happens when leverage meets scarcity in a critical commodity market. The Hunt brothers saw it in 1980. Nickel traders saw it in 2022 when the London Metal Exchange had to cancel trades and halt the market. It happens when the gap between paper claims and physical reality becomes impossible to bridge. So what does someone do with this information? The answer depends on who they are. For institutional investors holding short positions, the time to exit is before stage 1 begins. Once physical tightness appears, exit costs escalate exponentially. For strategic buyers, the opportunity exists now. while attention remains elsewhere, while prices remain historically suppressed relative to fundamentals. For industrial users, supply chain security becomes more valuable than cost optimization. Locking in physical delivery agreements, building inventory buffers, these aren't expenses, they're survival strategies. And for observers, those watching from the sidelines, understanding this mechanism provides clarity about what's really happening in global markets. Because silver's move to $100 won't be an isolated event. It will be a signal that the commodity supercycle has returned, a signal that paper claims are being tested against physical reality, a signal that the monetary system is shifting in ways most people aren't prepared for. China positioned for this years ago. They accumulated when prices were low, when sentiment was negative, when Western institutions were busy elsewhere. Now the mechanism is armed. The margin bomb sits at $25,000, and the path to $100 isn't a possibility. It's a sequence already underway. The only question left is timing, and who's positioned correctly when the sequence completes.